Hey, did you know there's a way to pay zero capital gains tax on the first $10 million? I'm Fook with Alphabet Group, and today we're going to talk about qualified small business stock. I'm going to go through the details of what this is, who qualifies, and actually how to qualify to do it. So now let's go through what this is. It's pretty much a stock that qualifies for non-taxable gains, meaning that you don't pay federal income tax on it. Unfortunately, California doesn't conform to this rule, so you still have to pay it on California side, but still, not paying on the federal side is still a big tax savings. And to meet this, you have to have certain qualifications to make sure that you qualify under the qualified small business stock rule. Now, who qualifies for this very special tax break? It's pretty much going to be startup founders, early employees at startups. If you have stock grants where the stock price is less than $1, that usually might qualify. And the most important thing is that companies in technology, retail, wholesale, and manufacturing will qualify. Now, who doesn't qualify? People in the hospitality business. So if you sold stock at a company where it's a hotel or a restaurant, in farming, mining, or personal service, like me as an accountant, my friend Phil, who's a lawyer, he won't qualify. My doctor friends won't qualify. And anyone in banking and financial, they won't qualify for this qualified small business stock. So the only person who really qualifies are people who work at startups. And that's where most of the majority of people will be able to take this tax break. Engineers are so lucky. Now that we know who qualifies, let's see how you qualify, because there's actually a checklist that I made to make it easier for everyone to follow. As long as you answered yes to every single question, we are good and you qualify for the qualified small business stock. Now, the first question is going to be, is a company, the startup, a C corporation? Most of them are going to be C corporations. If it's an S corporation or a LLC, we're going to have a little bit of trouble. So make sure that it's a C corporation. Was a stock purchased after August 9th, 1993? That's easy to determine. It's a yes or no. Was a stock purchased directly from the C corporation? So usually, if you're an employee of the corporation, you could buy that stock directly from the company itself. You can't be buying, just like for investors, if they can't be buying it from a third party or anything like that. So you have to buy it directly from the corporation itself. And then, was the stock held for more than 5 years? I put a little asterisk here, as you can see. And what this asterisk is means that if the company happens to sell or get purchased before your 5-year mark, there is a way around it where you could still defer the gain. It's a little complicated, but I'll explain that at the end. The next thing is that, is a corporation an active business, meaning that what they're doing is actually a running business. So if you're working at a startup, it usually means that they're running a business and they're not a holding company. Did the company use 80% of its assets for the business? So if you're a startup, usually they would qualify for this because they're using the funds to help pay for payroll, R&D, things like that. So usually if you're working at a startup, you qualify for that section. Now, the hardest part is determining if the company has assets of less than $50 million at the time you purchase the stock and right after you purchase the stock. So what you have to do is try to figure out if the company has $50 million in assets. And one indicator that I followed is that if your strike price, your purchase price of the stock is less than $1, usually it will qualify for having less than $50 million assets. It's not guaranteed, but usually I find that does qualify. So you got to make sure that somehow you ask the company that at the time when you purchased stock, did it have less than $50 million in assets. If you're a founder, you should know whether you did or not. And remember, part of the assets is if they raised their round of funding and they got the funding inside their bank account, that amount that they receive is part of assets. So if they received more than $50 million in funding, then most likely they're going to be over that $50 million mark and you won't qualify. So you got to make sure that when you bought the stock, especially hopefully before any big rounds of funding, that all assets that the business had was less than $50 million. If you qualify for all of these items, then you get the qualified small business treatment. And here are the tax benefits when it comes to that. What you're going to get is that if you purchase the stock between this date right here, you get 50% exclusion of your gains. So meaning that you only pay taxes on 50%. Now, if you buy between these dates, you get 75% exclusion, meaning that you only pay taxes on 25% of your gains. And then if you bought it after September 2017 of 2010, then all of it is excluded. The whole thing. It's one of the best treatments that you could get when you work at a startup. Now you'll notice there's some asterisks shown on these two, and the reason is because these two are still subject to some AMT tax, so you just want to be careful that even though you're not paying regular income tax, there might be some AMT tax that you have to pay, so definitely be careful for that. When it comes to AMT, this is where tax planning really helps. Now, how are you going to report this on your tax return? It's super simple. All you have to do is get this form, the 8949, and you want to make sure you go to the second page. So this is the first page, and this is for short term. You see this? So you don't want this page because most likely your stock's going to qualify for long-term capital gains. So what you do is going to go to the long-term capital gains page, and you're just going to put, I just name it QSBS, that stands for Qualified Small Business Stock, and just the company name. And I just put the dates of purchase, date of sold, however much the proceeds were when it was sold. So let's say $2 million, just to say you bought it for $20. And you want to put this code right here, Q. Q is very specific to qualified small business stocks, so the IRS knows that this applies to that. And then you're going to make the adjustment. So that way, this adjustment is just showing a negative number, that what is the amount that you are excluding from taxes. And then from here, it just shows 0. And just as a note, make sure you keep records of your purchase, because that's going to be very important in case the IRS questions this. So the next thing I want to bring up is what happens if you don't meet the 5-year holding period. And I actually had this happen to a couple clients that worked at Trello. They were actually 6 months away from the 5-year holding period. So when Trello got bought out, they just needed 6 more months to qualify for this 5-year holding period, but they couldn't because they were just short by that 6 months. And there was a way I found out that they could try to help defer the gain a little bit, but it gets a little complicated. So the way you want to do it, it's called a 1045 rollover. So what you're going to do is you're going to take the proceeds from the original stock. So let's just say this is Trello, the proceeds that they sold, you're going to roll it over to another qualified small business stock, meaning that you have to find another company, pretty much another startup that has the same qualifications within 60 days of the sale of this Trello stock, right? So you have 60 days to roll it over to a new startup. Now, the problem is that the startup has to qualify for all of these same qualifications to qualify. It has to be a C corporation, make sure it has $50 million in assets. So make sure that the new company qualifies for all of these. So 2 things is that you have to make sure that you roll it over within 60 days and that you have to have held a stock for more than 6 months for it to be able to qualify for the rollover. So that's pretty much what a qualified small business stock is. It's going to really relate to early startup founders or early startup employees and founders, making sure not only do the 83B election, I have another video on that you could watch, but definitely keep this in mind because not a lot of people know about this. It's kind of like a hidden gem when it comes to the startup world. Please give this video a like and a share, especially with your colleagues. It really lets me know that this content was useful. Other than that, I'm off to my next video.